I mean, no surprises. They're going to continue with the status quo of having a floating exchange rate. I think the drama would have been if they'd moved any other way.
I think so. I mean, obviously what we had expected was perhaps further measures to be announced by the Prime Minister in his press release. He had been fairly vocal about this task team that he'd assembled and the measures that they would potentially announce to address the weakness in the currency and the turmoil in the financial markets, and furthermore the lack of confidence that markets seem to be having in their shilling. So we'd expected perhaps a little bit more from the Prime Minister in his address today, and actually he didn't tell us very much else than what we'd already known about the measures that had been put in place and the stance at the moment. So perhaps underwhelming his address today. He did, for example, mention the fact that they would be looking to add foreign exchange or supply foreign exchange in the interbank market. And that leaves us with some questions how this relates to the circular that was issued by the central bank last week, whereby the central bank had indicated that it would be seeking to provide dollars directly to the corporate sector. So it's a bit unclear what he was referring to with the statement and how that will seek to address some of the concerns around the currency. Other than that, he reiterated that they will seek to front load some of the disbursements under the arrangement with the IMF, and that the IMF will be coming to Kenya later, or actually early next week, and they will be discussing the front loading of the next disbursement to later in this quarter rather than next year. And that obviously may, to some extent, add to the foreign exchange reserves and the ammunition that the central bank would then have to supply US dollars to the sector. But that process is undoubtedly going to be protracted as the negotiations with the IMF continue, and obviously the IMF will require board approval for such a move. So in the immediate term, that won't alleviate the situation.
All right,
so,
Yvette, let's go back to the basics. We do know that for some time, as people are trying to look at other measures available to the CBK and to the task team, one of the more viable options, at least for interim stability, would be foreign exchange controls. What do you make of that?
I think that's the least obvious measure that they would, well, it's obviously a measure, but I think there are more conventional methods that the central bank could use to further tighten monetary policy in order to rein in the weakness on the currency. So we saw a fairly aggressive move yesterday when the central bank increased the central bank rate by 400 basis points. And obviously this is something that I think markets have been calling for an extended period of time. It's perhaps overdue, but it is the most aggressive move we've seen the central bank make in a very long time, and the tone of the central bank in its statement had definitely become substantially different than in more recent statements. So it seems to become more aware of the issues that the financial markets have been aiming to raise, and the need to address raising inflation. So I think there are other measures and further tightening that the central bank could consider. One could be, for example, further tightening of the cash requirements ratio that had been loosened previously by the central bank. It now stands at 4.75% with further flexibility in that arrangement to allow it to drop to as much as 3% on a monthly basis in order to achieve that 4.75 rather on a monthly average than to be maintained on a daily basis. That is one mechanism that the central bank could consider tightening in. Obviously, it still has the option to continue to conduct reverse repos to tighten monetary policy. And in the medium term, it also could, in its next meeting, tighten the central bank rate further. So I think those are options that it has at hand to further enhance the credibility of its monetary policy. And we'll keenly be watching whether or not the central bank will continue in the tone that it took in its most recent monetary policy statement.
The feasibility of some of these measures, Yvette, because reverse repos, we've seen the CBK entering the market on several occasions in the last 2 months. In that regard, it hasn't really worked to support the currency. Monetary policy tightening, there were calls for a more decisive move. We saw it this week with the increase by 400 basis points, but the shilling is actually just depreciating further. It's now at 102 shillings to the dollar. So with the exception of the cash reserves, it doesn't seem like all these other dimensions are working.
Well, I think it's about the combination under which the central bank would implement such measures and the consistency under which it implements such measures. In support of the high interest rate, tightening liquidity on the interbank market will undoubtedly provide support to the currency. We've seen that actually the interbank market still remains quite liquid. So it would need further tightening of liquidity in order to rein in that liquidity, and that would, for one, need reverse repos and or the cash reserve requirement in addition to the raise that we've already seen in the central bank rate, for that to allow it to be effective in the in reining in the exchange rate weakening that we've seen. So I think it's a combination and the consistency of those measures that the financial markets are still looking to before it actually believes in further strengthening or stabilizing of the currency. So I think this is a first step, but if the central bank continues to walk this line, that we actually could see financial markets reversing its sentiment towards the Kenyan shilling.
Okay.
And rates are starting to look more attractive, so we could see that currency turning around.